Buying a rental house has long been a popular way for regular people to build wealth. But for landlords in two countries on opposite sides of the globe, math isn't working anymore. With higher borrowing costs cooling real estate markets globally, a change in government policy is an added burden for mom and pop landlords in the UK and New Zealand. Both countries, seeking to help first-time buyers afford properties, have curtailed the tax break that allowed mortgage interest to be deducted from rental income before owners pay tax on it. As the tax change collides with higher mortgage rates, landlords are scaling back or even liquidating their real estate investments. Nest eggs meant for retirement have turned into liabilities, with properties running at a loss as rent payments fail to cover mortgage costs, maintenance, and taxes. Some are deferring repairs, and many are raising the rents, adding to a house cost crisis as battered families. David Joseph, 46, paid about $270,000 for a two-bedroom house 2 years ago in Milton Keynes, a city about 50 miles northwest of London. Since then, tighter regulations and faster inflation have made the investment much less attractive. He collects $1,290 a month in rent, but now spends about as much on his mortgage, bills, insurance, and renovations. I don't know what I'm going to do, said Joseph. This was supposed to be my pension part. The model many investors follow is straightforward: buy a property, use rent payments to cover mortgage costs and expenses, deduct the mortgage interest to reduce taxes, hold the property but as its value increases, and either leverage it to buy more real estate or sell for a profit. During the pandemic, low interest rates and rising property values made investing in a home that could be rented out alluring in many countries, including the U.S. But as rising home prices surged, landlords faced backlash as first-time home buyers struggled to enter the market. And while several countries, including the U.S., Canada, and Australia, still allow mortgage interest to be deducted on investment properties, higher rates have curtailed investor appetite sharply. A big difference in the U.S. is that most mortgages are fixed for 30 years, meaning landlords should be in decent shape if they lock in their purchase before the recent surge in borrowing costs. In the UK, more than a third of fixed-rate mortgages on rental properties, known as buy-to-let, are due to end in the next 2 years, leaving landlords vulnerable to the highest interest rate since 2008. That's pushed the yields on rental properties to record lows, and owners will be losing money on more than 180,000 homes by the end of 2023, according to consultant Capital Economics. The firm said of total returns on rentals will fall 5% this year, after averaging 9% gains over the past decade. In New Zealand, most buyers fix their mortgages for less than 3 years, and the nation's central bank estimates about half the stock of fixed-rate home loans are due to reprice in the next 12 months. Many landlords face a jump in interest rates to 6.5% or higher from historically low levels of 3% or less. With the tax changes making it even harder to turn a profit, mortgaged investors in New Zealand made up just 20.6% of overall home sales in the first quarter, a record low according to data from property consultancy CoreLogic New Zealand. In the UK, landlords have been selling their properties. The number of buy-to-let or second homes sold hit a record 47,000 in the 3 months to the end of November, a 21% increase from the same period in 2021, according to real estate agent Savills. The tax changes were driven by political pressure to address imbalances in the housing market. The UK announced the new policy in 2015 for New Zealand. It came in to the middle of the pandemic and induced real estate bubble. We saw house prices climb almost 30% in 2021. Both countries slowly phased out the deduction and allowed some exemptions, such as on newly built properties in New Zealand. Landlords in the UK, meanwhile, now receive a tax credit. In New Zealand, landlord Tim Horsbrew has found himself in a predicament he hadn't foreseen. After more than 20 years of investing in property, he needs to sell 7 sections of his 11 rental properties to keep his portfolio viable. Harsbrew said mortgage interest is now his biggest expense. He has, about news alone, $2 million of mortgage debt that is affected by the new rules, on which he pays about $66,000 heirs costs per year. Harsbrew is frustrated that landlords are now being taxed on income rather than profit, but he also feels lucky that he can reduce his debt by selling a couple of properties. We are paying tax on money we haven't made. That really hurts, he said. Some of the younger, new